Most active investors know about the Nifty 50 index. It has delivered an impressive 15.6% CAGR over the last 5 years. Amazing, right? But let me ask you something. Have you ever thought about investing in the Nifty 50 index and beating its returns at the same time? Sounds confusing? Don't worry. By the end of this video, you'll not only understand how to invest in the Nifty 50 but also how to potentially beat its returns using 2 simple techniques. Excited? Stay tuned till the end because this is going to be super valuable for you. Let's start with the basics: how to invest in the Nifty 50 index. It's really easy. Just open your trading platform. I personally use Kite, but you can use any platform you like. Once you're in, search for NiftyBees. This is an exchange-traded fund, ETF, that tracks the Nifty 50 index. Now, some of you might wonder, what exactly is an ETF? Don't worry, it's simple. Think of it as a prepackaged basket of stocks. Instead of buying all 50 stocks in Nifty one by one, you get all of them in a single product, an ETF. It's like a combo deal. And the best part? The cost of one NiftyBees is currently just around 275 Indian rupees. Alright, now comes the exciting part. How do you beat the Nifty 50's returns? Here are 2 easy techniques you can use. First technique is to use relative strength index. When it drops below 30 or 40, depending on your preference, it means the market is oversold. That's your signal to buy NiftyBees. And don't say you don't have money to invest. If you've watched my video on creating an opportunity fund, you'll know how to save money for such moments. If you haven't, click here to check it out. Second technique is to use day moving average, DMA. Watch for the 100-day or 200-day moving average. If the price of NiftyBees falls below these averages, it's often a great time to buy. These dips are golden opportunities for long-term investors like you. Here's a pro tip: don't limit this strategy to just NiftyBees. You can use it for other index funds or even mutual funds. But remember, this isn't meant for individual stocks unless the stock has very strong fundamentals. There are other tools too, like MACD or trend reversal patterns, but for long-term investing, you don't need to complicate things. RSI and DMA are simple and effective. One small tip: don't use both tools at the same time. Pick the one that works best for you. If you enjoyed this video, make sure to like, share, and subscribe to my channel. Let me know in the comments if you want more tips like this. Let's grow wealth together. See you in the next video.